In 2005, the biggest mortgage lender in America made a promise with a number in it. $1 trillion lent by 2010 to minority and lower-income borrowers, the people the banks had been refusing for 50 years. So how does a favor to the poor become the 2008 crash? He found an answer, and it worked. Countrywide became the largest home lender in the country and wrote more than 4 million mortgages. The man who signed that promise was a butcher's son from the Bronx who started as a messenger in a mortgage office at 14. For 40 years, he said the same thing. The door to a house had been held shut against people like his father. He meant it. Then, in December 2011, the Justice Department filed the largest fair lending settlement in its history against that company. More than 200,000 Black and Hispanic borrowers, it alleged, had been charged more than white borrowers with the same credit. He had written, in his own email, that one of those products was the most dangerous product in existence. Then he sold about $140 million of his own stock. The promise was kept. Look at what was inside it. Start with the clause everybody agrees on. Open the door. Angelo Mazzillo and David Loeb founded Countrywide in 1969. 2 men, 1 office. What kept it moving was a conviction, and it was not invented for a press release. Mazzillo watched his father get refused. He said the mortgage business decided in advance who counted as the right sort of borrower, and that the deciding happened before anybody looked at the numbers. So Countrywide published commitments, $1.25 billion in 1992 for first-time and minority buyers, $100 billion by 2001, which it hit early, $600 billion after that, and in January 2005, $1 trillion. Each promise got bigger because each one kept getting met. You will read everywhere that Countrywide wrote 1 in 5 American mortgages. So we read the quarterlies. Its own filings say 17% at the peak in early 2006 and 12% by that autumn, about 1 in 6. Big enough. The belief was real. That is exactly why the number kept growing. Second clause, and this is where the audit stops being comfortable, $1 trillion. Ask how a company lends that much, not whether it should. How? Countrywide did not keep the loans it made. It wrote the mortgage, and within weeks it sold that mortgage to Wall Street, where it was bundled with thousands of others and sold on again. So the company deciding whether you could afford the house was not the company that would lose money if you couldn't. Its income was a fee, earned at signature. Once the loan was sold, whether you paid for 30 years or stopped in 18 months made no difference to that fee. It was already banked, which turns underwriting inside out. In an ordinary lender, standards are a risk control. They exist to stop you lending to someone who cannot pay. In this machine, they control no risk at all. They are a tap on revenue. Tighten them and less comes in. Loosen them and more does. And there was a $1 trillion promise on the wall, with a deadline on it. To reach $1 trillion, the word yes has to stop meaning what the borrower thinks it means. Third clause, home loans. What was a Countrywide home loan actually made of? One product was called Fast and Easy, and it was named accurately. You stated your income. Nobody checked it. Then the pay option adjustable rate mortgage. Each month you chose your payment, and the smallest choice did not cover the interest. The unpaid part was added to what you owed. So you paid on time, every month, for years, and your debt got bigger. Countrywide booked that growing balance as income. And the 100% second mortgage, no deposit. Nothing of your own in the house at all. The Justice Department later described what these did at the 2 or 3 year mark in one phrase: exploding adjustable interest rates that increased suddenly. The payment you had been managing was replaced by one you had never seen. Here is what separates this from every other story about a man who did not understand his own product. He understood it exactly. In his own emails, later quoted by the Securities and Exchange Commission, Mazzillo called that 100% second the most dangerous product in existence and said there could be nothing more toxic. Of the pay option mortgage, he wrote that the company was flying blind. He knew in writing, it kept selling. Fourth clause, the people the promise was made to. In December 2011, the Justice Department filed a complaint, and the allegation was not that Countrywide refused these borrowers. It was the opposite, and it is worse. Countrywide, the department said, let its loan officers and brokers move a loan's rate and fees away from the price the borrower's own credit had earned. Nothing checked where those moves landed. They landed in one direction. The complaint counts more than 200,000 Black and Hispanic borrowers across 180 markets in 41 states charged more than white borrowers with comparable credit. More than 10,000, it says, were steered into subprime while they qualified for prime. All of them met Countrywide's own rules. The Attorney General gave an example. In 2007 in Los Angeles, a qualified Black borrower taking $200,000 paid on average about $1,200 more in fees than a similarly qualified white borrower. Countrywide settled for $335 million and admitted nothing. Nobody has put that settlement against what it paid for, so we did. Spread across the borrowers, it is about $1,675 each. Now take the Attorney General's own loan at the smallest premium that legally counts as a higher-priced mortgage. The extra interest alone eats the whole settlement in about 7 months. The loan had 29 years left to run. The door opened. It opened onto a more expensive room. Last clause, by 2010, the deadline arrived early. In August 2007, Countrywide drew down an $11.5 billion credit line because nobody would lend to it overnight anymore. In January 2008, Bank of America agreed to buy it. By July, the largest home lender in America had stopped existing as a name. So what did the man walk away with? There is no single answer, and that is worth saying out loud. One compensation firm says $410 million. Contemporary reporting said 521. A congressional committee's figures add up to nearer 650. We went looking for one number, and there isn't one. What is not in dispute is smaller. The Securities and Exchange Commission said he sold nearly $140 million of stock as the company deteriorated. In October 2010, he settled for $67.5 million and a lifetime ban from running a public company without admitting or denying anything. Bank of America paid $20 million of that under a clause in his old contract. His own share was $47.5. The criminal investigation closed with no charges. He died in 2023 at 84. The company was erased, the borrowers paid, and the fortune is the only thing here that never fell. Subscribe if you want the rest. This has been Rags to Riches.